Good evening, students. Welcome to the session. Have you revised the last class? We were on the AOP, BOI. Any questions that you have with respect to the last class that we have done? Yes, we have almost completed the assessment of various entities, and today we'll be just, starting up with the cooperative societies, and then with that, the entire topic will get over. So if you have any questions regarding the last class, you can please ask me. Yes. Any doubts? Have you revised or not? Yes or no? Okay. If there are no doubts, what we will do is we'll start with the topic on cooperative society. Now, whether cooperative society is the assessee, yes or no? Yes. Good evening, Ginny. Yes, whether cooperative society is the assessee or not, and what are the tax rates for the cooperative society students? What is the tax rate for cooperative society? 87A rebate will not be applicable for 67A. Ankita, that's a very good question. So 87A rebate will be there. It will not be available for 67A as in C. So 67A computation that you will do, that will go to your total income for sure. Okay. Now, if your slab is lesser than 5 lakh, right? If your slab is lesser than 5 lakh, then you will not be end up paying any tax liability. So you will get a 87A rebate for sure. And then, in fact, you will not get any rebate under 110 because you don't have any tax liability as such. So you will get 87A rebate. There is no stoppage for that. Okay. Yes. So what is the tax rate, students, for the cooperative society? Yes. You have done this in your basic concepts class, students. Please tell me fast. I need the quick answers. Yes. Nobody is giving me the answers. What is the tax rate for the cooperative societies?
Ma'am, if total income under 10,000, it's 10%. If between 10,000 and 20,000, then it's 1,000 plus 20%. And exceed 20,000, it's 30%.
Correct. So basically, for the cooperative society, there is a slab rate, right, which is applicable. Now, is there any concessional rate also for the cooperative society?
Ma'am, 22%.
Yes, 22%. There are two tax rates which are applicable for the cooperative society. What are those?
Ma'am, 15% and 22%.
Correct. Yes. So for the cooperative society students, there is the normal tax rate, which is up 0 to 10,000, 10%, 10 to 20,000, 20,000, more than 20,000, 30%. And the surcharge is what? On that tax rate, what is the surcharge? What is the surcharge applicable to a cooperative society? What is the surcharge?
Ma'am, it's a 7%.
Correct.
More than 1 crore, but less than 10%.
Correct.
And 12% if more than 10 crore.
Absolutely correct. So surcharge is 7% and 12%. If more than 1 CR, less than 10 CR, it is 7%. If it is more than 10 CR, it is 12%. Then cooperative societies have the similar regime as the normal companies. So manufacturing cooperative societies get the 15% tax rate. They can opt for 15% tax rate under 115BAE section, which is similar to 115BAB. Their surcharge is 10%, which effectively makes it to 17.16%. So any resident cooperative society engaged in the manufacturing or generation of electricity, which is set up on or after 1/4/23 and commences the production or manufacturing or generation of the electricity on or before 31st March 2024. And if it is not claiming certain deductions, which are basically additional depreciation, 33AB, scientific research, then 35AD, all of those, 80C to 80U, other than 80JJAA, it will be able to claim this 15% tax rate. So it's very similar to 115BAB section, which is there. And for other cooperative societies, there is a again similar rate as applicable to the companies under 115BAA, 22% rate plus surcharge of 10% and plus cess of 4%, which makes it to 25.168%, which is under 115BAD. There are no conditions, only the condition is that you should not claim the specified exemptions and deductions. Are we clear? Yes or no? So these are the tax rates for the cooperative society. This you have already done so far. Now, under this chapter, what additionally we are going to do is, besides the tax rate, is going to be the deduction under section ATP. Have you done that as well or not? Yes, have you done ATP or not? What is ATP? You have already done the deductions chapter. What does ATP say? Yes. You've done deductions very recently, isn't it? What is ATP? Yes, students, please faster. Why nobody is answering today? Yes. What is ATP? ATP is the deduction which a cooperative society gets, isn't it? There are multiple incomes on which the cooperative society gets the income-based deduction. So if a cooperative society has certain activities which are specified activities like, carrying on the business of banking, cottage industry, fishing, in all those cases, the whole of the profit and gains which are attributable to such activities are given as the deduction, isn't it? Then, in case the cooperative society is engaged in other than the specified activities, then it gets, if it's a consumer cooperative society, then 10,000. If it's an other cooperative society, it gets a flat deduction of 50,000 rupees. In case of income derived by way of interest or dividend by the cooperative society from its investments with the other cooperative society, then that is also allowed as deduction under ATP. In case of cooperative society, which is not a housing society, right? Where the gross total income does not exceed 20,000, the income by way of interest on securities or rental income is also allowed as deduction under ATP. So there are multiple deductions which are allowed under ATP. Yes or no? Have you done this or not? Yes. Students, at least tell me, have you done this ATP or not? Yes or no? Yes, right? So you should remember, okay? So this all topics you have done so far, we are just kind of putting a recap to this. But what additional I want to discuss over here is, you can write here, taxation of cooperative societies. You can write tax rate, refer basic concept class. Okay. One is the normal 115 BAD and next is 115 BAE. Okay. Then you have section ATP deduction, refer chapter 6A deduction class. What we are going to discuss over here is concept of mutuality. Do you know what is the concept of mutuality by any chance? This, I assume, would have been taught to you under PGBP also. Because we have a section called section 44A under PGBP. Have you done this section? At least you can give me an idea whether you have done this section or not. Yes, have you done this section 44A? Yes or no? You don't even remember whether you have done this or not? Okay. Let me first explain you what is the concept of mutuality. So mutuality, students, means that one cannot make the profit from one own self. It's like, the contributors and the beneficiaries are one and the same. So, many people have these concept of, kitties or, kind of putting the money into one basket, which will be used for the benefit of everyone else, isn't it? If you see the way these gymkhanas, the clubs which are there, the uh, particular cooperative societies which are there, they work on this particular principle of mutuality. What does principle of mutuality say? That the receipts which these trade organizations, professional organizations, which are collecting from its members are not liable to tax because there is no profit element involved into this. There is no profit element involved into this because these receipts which are collected are to be utilized for the benefit of the contributors only. So there is a very clear establishment of link between the one who is contributing the funds and one who is getting benefited from those funds. Those are the same persons only. So one cannot earn income out of one's own self. This is the logic of principle of mutuality. What does principle of mutuality say? That one cannot make profit from one own self. So if you see, how does gymkhanas work, student? Yes, have you seen how these clubs work or gymkhanas work? Any idea? What do they do?
They collect money from the members and then utilize it for their benefits, like giving them services.
Correct, absolutely. So if you see these clubs are there, there are these big clubs, in Mumbai also, I'm sure in Delhi also, in many other cities, there are these clubs which are operating. Clubs means not the clubs which are, having the disc and the pubs. I'm not talking about those clubs. Clubs means where basically the members get so many facilities, like they get a hall on rent, they have a space available, They have certain activity area available where they can, play indoor games. They have the gyms inside the club. They have, spas inside the club. So they can use those services. So what they have to do is to become a member of the club, they have to pay certain membership fees. And once they pay the membership fee, they can avail any of the facilities that these clubs are providing. Same way, even the gymkhanas operate. Gymkhanas are also nothing but the club only in a manner. Or even if you look at the cooperative society, you must be staying in some sort of, building, some sort of cooperative society. Now, what happens in the case of a cooperative society is housing cooperative society, or for that matter, if you have offices in a commercial space, then that commercial space is also registered as a cooperative society, if you see, right? So again, whether it's a housing society, whether it's a commercial society, they all operate on the same principle. They collect the maintenance, right? You have to pay the maintenance, whether you stay in a house or whether you operate an office in a commercial premise, you have to pay the maintenance. Now, that maintenance amount is utilized for what purposes? It is utilized for the purpose of the security, it is utilized for the purpose of your AMC of the equipments which are there, like for example, lift which is there. There may be certain cleaning staff which is there. So we are paying to them. So this maintenance amount goes towards all of these facilities to maintain the clubhouse, to maintain the garden, to maintain the gym, right? So your maintenance amount is basically being used for your benefit only. Now here, this concept of mutuality says that one is not able to really profit out of its own self, right? Because the fees which are collected are being utilized for the members, and therefore any kind of general services that we are providing to the members should not be taxable, or the receipts which are collected from the membership fees, from the fees which are collected for joining, are not taxable on the ground of mutuality. Are we getting this particular point? Is this mutuality point being clear to you, right? So the question arises, now there are multiple cases in which the concept of mutuality has been tested. Now, what are the kind of charges on which mutuality may be applicable? So you can just write here any kind of fees for providing these services, or rather you can write general services to the members. These are not taxable. Do not write exempt. Why I am not using the word exempt? Why here instead of writing not taxable, I'm not writing exempt. Why I cannot say exempt on the ground of mutuality?
Because it is actually taxable, but the government is giving them exemption from tax.
No. See, if the government would have given the exemption from tax, there would have been an exemption under Section 10.
No, it is not an income according
Yeah,
to
it is not an income.
Section.
Yes, yes. So, if I have an income, but there is a specific exemption, right? So, that is specifically said under the law. Without a specific exemption, unless it is a capital receipt, the income would be taxable. Are we getting this point? Is this a capital receipt? Answer is yes or no?
No.
Correct? It's not a capital receipt. So meaning it is falling within the kind of classification of income. One may classify this as income. So therefore it has to be specifically excluded. It has to be specifically exempted under Section 10. So you have to carefully use the words in exam. Now you are becoming a chartered accountant. You are writing your final exams. So you have to be carefully writing the words. It is not exempt. This is not taxable. This is not coming in the nature of income. This is not income. Because one cannot make profit out of its own self. There is no profit element. Because the owner, because the contributors are same as the beneficiaries. It is like I'm contributing for my own benefit. Let's say I keep my money in fixed deposit. Does the fixed deposit become my income? Answer is no. Interest on fixed deposit can be my income. But does the fixed deposit is my income? Answer is no. So this is the money which has been contributed for my benefit. So it doesn't become the income. I'm just giving this money to a society which is being formed, which is basically consisting of all the members only, isn't it? So this is not taxable on the ground of mutuality. So what kind of fees here would be there? Membership fees, then non-occupancy charges, cooperative society levy these non-occupancy charges. Transfer fees. So when you transfer your flat, they levy these transfer charges. Common amenity fund charges. So in Venkatesh Premises Cooperative Society Limited, it has been held that these charges would not be taxable on the ground of mutuality. Venkatesh Premises Cooperative Society Limited. It's a Supreme Court ruling. It has been held that these charges are not taxable owing to the application of the doctrine of mutuality. Are we clear? Yes or no? Is this clear? So any transfer fees which is received by a cooperative housing society, whether from the outgoing or from incoming members when the transfer happens of a flat, is not liable to tax, or any non-occupancy charges which are there. So if you're not occupying the flat, there are non-occupancy charges which are levied. Right? Because here there is no intention, taint of commerciality, trade or business. And therefore, this will not be taxable on the grounds of mutuality. Now, what about the interest which is received? The interest which is received on the fixed deposit made with the banks by, let's say, the cooperative society, if the banks are in fact the members of that cooperative society. Now, not cooperative society, let's take an example. There are these clubs, right? Now, sometimes the banks are also members of the club, isn't it? Banks are also the members of the club. Now, sometimes it is possible that I may keep the fixed deposit as a club with the bank. So, in that particular case, whether the concept of mutuality will apply in that case or not.
Ma'am, on interest, no.
Sorry?
Because इंटरेस्ट पे म्यूचुअलिटी कंसेप्ट नहीं लगेगा मैम.
Yes. So, where let's say for example, the club is depositing the surplus funds as a fixed deposit with the banks, who may be even the members of the club. Can the mutuality apply? So, this was decided in the case of Sikandarabad Club by Supreme Court. The Supreme Court observed that the principle of mutuality works on the principle that, or the test that there should be complete identity between the contributors and the beneficiaries. And the intention of contributing the fund should be for the furtherance of the objective of the club. right? Now, what is the object of the club? That can be, of course, ascertained from the memorandum or articles of association. And there should not be any intention to make a profit from the contributions which are made to the fund. And this has to be utilized basically for the benefit of the contributors only. Now, in relation to the deposit of the surplus funds which are earned by the club. So, principle of mutuality is applicable only till the stage where the funds are collected from the members and they are being utilized for the benefit of members. If the funds are deposited with the bank to earn the interest, then on that ground, the mutuality will not be extended, because here my objective shift from not applying the funds for the members, but for earning the interest on the surplus funds which are lying. So that even if I'm keeping my FDs with the banks, which are my members only, but there is no mutuality existing over there, because there what I'm doing is I'm giving the surplus funds to the bank to earn the interest. So the identity between the contributors and the participators gets lost. And the surplus funds are not being applied for the benefit of members, but are invested with the banks, who will then, of course, use those funds to grant the loans to the general public. So therefore, I don't have now funds with me. So the identity between the contributors and participators getting lost. Are we getting this point? So therefore, in this particular case, if the objective is to earn the income, then the concept of mutuality will not be applicable. And this will become taxable. Are we clear? So just write down interest on fixed deposits kept with member banks, taxable. Mutuality is not applicable. Mutuality will not be applicable. So this was held by Supreme Court in Sikandrabad Club. Are we clear? Yes, any questions, any doubt with respect to this? Yes or no, students? Yes, is this clear? So any interest on the surplus funds will not constitute the non-taxable income. This will be taxable. Okay. Now, yes.
Ma'am, you are talking about clubs. In some clubs, they are like lottery system and something. They say that na contributed and they give a gift to them. That also is a mutually concepts and it is other than that.
See, if it is for my benefit, only then it is subject to mutuality. If it is not for my benefit, if it's a case of a lottery system, then I don't think the mutuality applies. Mutuality is basically where it is only for the benefit of all the members. If it is like benefiting one member, then of course the mutuality will not be applicable. So you're talking
Ma'am,
about something kind of kitty system
yeah,
where
ma'am. Sometime like everybody start putting money in a monthly basis and they withdraw like that. This
yeah,
also because they are distributed in their members only, whatever profit are they getting.
yeah. So basically, see, if it is for the benefit of members, as I said, So let's say, for example, if I'm collecting the money and then, it's just that kind of giving it back to the members, but depending on the chances whose name comes in that chit. So it will be again subject to the concept of mutuality because it's just for the members that the amount is taken and given to the members itself. That is not a problem. But in case it is given to outsiders also, then it would be not subject to mutuality. Okay.
Okay, ma'am.
Now coming to, this was the general services that we were talking about. Any amount which is received for providing specific services to the members. For example, giving hall on rent. So quite possible that I may be giving, let's say, clubhouse, my hall for some event to the members on additional rent, okay, which is not part of my membership fee. So now this is specific services to specific members. This shall be taxable under the head PGBP under section 28(3). Do you remember section 28(3)? Ginny, I'm not able to hear your voice. Yes. What is section 28(3)? Do you recollect? 28(3), what was it? Has this been discussed with you, 28(3)? Section 28. The following income shall be chargeable to income tax under the head PGBP. 3 says income derived via trade, professional or similar association from specific services performed for its members. So only the general services, if the receipts are for providing the general services to members, it is subject to the concept of mutuality. If the income is derived for the specific services to be performed for the members, then it shall be taxable under section 28(3). Has this been discussed or not? Yes or no? Yes or no? I need answers.
Hello, ma'am.
Yes.
Now my voice is coming?
Yes, Shani, I can hear you.
Yes, ma'am.
Okay. So 28(3) is for the specific services. So basically, if it is income from specific services, you will charge the receipt to tax minus any expenses which are there, you will claim it as deduction, subject to the principles of section 30 to 43, right? So that is about the specific services. Now there is one more deduction which is available under section 44A. What does 44A allows? What is this 44A? Any idea? You have done PGBP, so you must have done 44A. Yes, what is 44A?
Ma'am, a method of accounting related? No?
No, That is 44AA, books of accounts, maintenance of books of accounts. 44A, this is relating to the trade or similar associations. Yes, anybody can recollect? Yes. So, in case of the general services, if my receipts are less than the expenditure, resulting in the deficiency of income. If my basically expenditure is higher than the receipts, in case of only the general services, this is not applicable for specific services. This is only in the case of the general services that I'm talking about. If my expenditure is more than the income, then the deficiency which is there is allowed under 44A, which is half of the total income, which is restricted to the half of the total income. So what does 44A says is that while computing the PGBP, even though my income is not taken into account on the concept of mutuality, the deficiency which is there, the loss which is there, shall be allowed as the deduction while computing the income. So, this is expenditure minus my income. This is allowed as deduction under section 44A, but this shall be restricted to half of my total income. Okay? This shall be restricted to the half of the total income.
Ma'am, please give example. It is not
Example
clear.
can be, let's say I have collected the maintenance charges of rupees, let's say 10,000. I have expenses on, let's say gardening, let's say rupees 5,000. Security, I have paid rupees, let's say 7,000, right? So there is a deficiency of 2,000. So this is actually not taxable, right? On the grounds of mutuality. But if it results in deficiency, if there is a loss, then this is allowed as deduction under section 44A. And let's say if my total income other than this loss is, let's say, rupees 10,000. So half of 10,000 is 5,000. So any which ways, I'll get the entire 2,000 as allowance. If let's say, for example, if my total income would have been, let's say, only 2,000 rupees. Then this shall be restricted to half of total income, which is rupees 1,000. So balance 1,000 will be my total income. Are we getting this?
Ma'am, here total income means total taxable income other than these.
Correct. Yes. So this is only for the general services. Specific services which are there are already taxable under 28(3). and the expenses in relation to the specific services, you will get the deduction as per section 30 to 43B. So this 44A is not for the specific service. This is only for the general services. Are we clear about the cooperative societies? Yes or no? Any questions? Any doubts so far? Yes? Yes or no, students?
Clear.
Clear, all of you? Is the entire assessment of various entities clear? I'm giving you 2 minutes time. Just skim through your book and do let me know if you're fine with the entire topic, because we are done with the entire topic. I'm just quickly revising meantime what we have done so far. We started with the concept of MAT, right? Under MAT, under 115 JB, we discussed the several adjustments with respect to the MAT, isn't it? We discussed the several adjustments under MAT. We discussed what is the rate of MAT, what is the MAT credit we have discussed so far. Then we discussed how do you compute the MAT in the case of Ind AS compliant companies. There are additional adjustments which are there, right? OCI, which will not be reclassified to P&L, remember? Then we move to the concept of AMT, right? Alternate minimum taxes, where you claim only specified deductions under 80C to 80, sorry, not 80C, the income, the deduction in relation to the income, 80, IAIB, all of that, other than 80P. So in case of cooperative societies, the AMT is not applicable even when they are claiming the 80P deduction. Even when they opt for 115 BAE or BAD, there also AMT is not applicable, isn't it? So then we discussed about the AMT 35AD. If you're claiming 10 AA, in those cases AMT was applicable, right? Then we discussed about the partnership firm. What is the remuneration which was allowed as deduction? What is the interest which is allowed as deduction? And how the taxability of the partnership firm works. What are the different provisions which are applicable to a partnership firm as such, right? Then we discussed also about the AOP and BOI. The remuneration and the interest which is paid to the members of AOP BOI is not allowed as deduction. What are the tax rates for AOP BOI? What is the surcharge? How does the taxation work? If the shares are known, if the shares are unknown, in those cases, how the credit is to be given in the hands of the members where the AOP or BOI is taxed, right? So all of that again we discussed. Then we discussed about HUF, what is the tax rate, what happens in the case of partition of the HUF. We discussed about the tonnage tax scheme, right? And today we have done the cooperative society. Is there any question, any doubt, anything you want to ask before we move to the next topic? Yes or no? Or is everything clear? Yes? Clear? Okay, perfect. So let's move then towards the next topic, which is the taxation of trust. And students, I will request you to please practice the assessment of various entities as much as possible, because students, what will happen is you will then tend to forget. There are so many concepts under the income tax, right? So if you are not revising, you're looking how you're forgetting everything. So this is very, very important. You can expect good amount of questions from the assessment of various entities. And now, almost we are reaching on the last stage of the computational kind of chapters, which is the assessment of trust. After that, it will be, more so based with the assessment procedures, CIT appeals, all of that. So that will be a kind of theory portion, but majority of the computational portion is there until your second module, right? So I request you to solve as much as possible because that will give you a good amount of practice. Okay. So let's start with the taxation of trust. Let's give a new heading. Okay. Now on the taxation of trust, what are the different kinds of trust that we are going to see? The first part we will devote time on securitization trust. Second, real estate investment trust and the InvITs. Alternative investment funds, AIFs. And then finally, then we will start with the charitable trust. And lastly, it will be the private trust. Are we clear? So this is how your syllabus is more or less divided between these topics. So initially, we will do the concept of these trusts, which are the public trusts which are there. And then we will start with the charitable trust, and then we will move towards the private trust. Okay. So first is we will start with the securitization trust. Or rather, first let's start with the topic of the trust. So trusts are basically the not-profit organization. What is the meaning of trust? I put the money in the trust of an institution which is there, isn't it? And these funds will be applied for the different purposes. Now, trust is not a person. Trust is not a person under 231. Under Income Tax Act, trust is not an assessee. Trust is not a person. Trust is a pass-through entity. What do we understand by pass-through entity? The income of the trust is not taxable in the hands of trust because trust is not a person. Are we getting this? So there are different provisions with respect to the taxation of the trust. Now first, if you see, we will talk about the securitization trust. What is a securitization trust? So let us understand with the help of the example that how the securitization trust works. So let's say there is a bank or a financial institution, right? Let's take an example. There is a bank or the financial institution. This gives the loans to the borrowers, right? Any kind of loans. And it takes the give the loan on the security of the assets. So basically the borrower will pledge these assets to the bank, right? All the banks which give the loan give on certain level of security, isn't it? Right? So therefore, this bank give the loans on the underlying security which is there or by pledging some kind of security. So in that particular case, these banks, when they give the loan, isn't it? So therefore, when they give the loan, the assets which are received in return, what do the bank do with these assets?
Ma'am, depend on the security of assets is like sometime it's a house and then bank is not doing anything on it. Or you are talking about gold loan.
No, any kind of assets that it receives. So the assets that the bank receives by giving the loan, what does it do with those assets? So see, what in order to monetize this, right? It enters into this process of securitization. Now, what is securitization? Securitization basically means that it is a process that involves the pooling of the assets to a particular trust. So, this securitization trust takes these assets from the bank, right? The securitization trust will take these assets from the bank and will in fact give the funding to the bank. So the bank will keep or will pledge these assets, will pool these assets to the securitization trust, which will indeed give the loan or funding to the bank. So that for the bank, these assets get monetized. So the primary purpose of the securitization trust is to take the assets from the bank and generate the cash flows for the bank. So the bank will in fact pledge the assets with the securitization trust, which will give the funding to the bank or the financial institution. Are we getting this particular point? So
Ma'am,
this,
you're talking about bill receivable and all these
yes, yes,
securities. Okay.
yes. So this is basically done, see, to reduce the risk of bankruptcy for the banks also. So here, the securitization trust will hold the custody of the underlying assets and they are responsible to give the funds to the bank till the time the loan is over. So securitization trust in fact enables the bank to convert the illiquid assets into the cash flow. Are we getting this point? So that is the reason why these securitization trusts are open up. So under securitization trust, again, what happens is the securitization trust also has received some sort of investments from the investors. It's not that, securitization trust is without any investments. So even the securitization trust, which is there, it would have received some sort of investment, some sort of funding from the investors. So securitization trust, what it will do is it will issue the security receipts to the investors and the investors will give the funding. Yes, Ginny, you have a question?
Ma'am, yeah. Over here, we are talking about the borrowers and the bank, and the securitized trust is a third person. Is it? Then the borrower, is this trust is only for the business, any जो कंपनीज वगैरह होते हैं सिर्फ उन्हीं के लिए, या फिर जो नॉर्मल पर्सन्स जाते हैं, क्योंकि वो लोग तो ट्रेड रिसीवेबल पेबल में डील नहीं करते। तो ये जो बोरोवर हैं, ये सब सारे के सारे बोरोवर इसमें इंक्लूड हो रहे हैं, या फिर सिर्फ जो कंपनीज हैं वो इंक्लूड हो रहे हैं?
No, so they see the borrowers are nowhere involved. They do not know about the securitization trust. So it is the banks which are putting their assets to the securitization trust to generate the cash flow.
यस मैम, क्लियर
Okay.
क्लियर।
So basically, the securitization trust which are there, they operate as a special purpose vehicle, or we may call
Yes,
it as a pass-through entities,
यस मैम।
where the securitization trust will issue the security receipts to the investors. The investors will give the funding to the securitization trust. The whole objective of the securitization trust is to give the funds or the cash flow to the bank and get these assets, and then securitization trust will monetize those assets.
Then, ma'am, this securitization trust, we can consider it as mutual fund also?
Not mutual fund. See, mutual fund is basically where it derives the value from the underlying securities. Here we don't have underlying securities. Here it is mainly like the assets. It is
Yes,
the assets. It's not the securities. Under mutual funds, you have the securities, right?
yes, ma'am. Clear.
So now, how does this taxation of the securitization trust works? Let us understand that. We have understood what is the securitization trust, but how does the taxation of the securitization trust work is very, very important. So, the income of the securitization trust from the activity of the securitization is exempt under 1023DA. So the income of the securitization trust, you can write here, is exempt under section 1023DA. Yes, so the income is exempt under section 1023DA. See, if the bank defaults on the payment, bank is again a financial institution. It will not default unless it goes for the bankruptcy. See, the bank is subject to, Ankita, a lot of norms of RBI, so it will not really default. And there are also assets pledged with the securitization trust, so it can, anytime invoke the assets or sell the assets to realize its proceeds. Clear? Now, income which is there of the securitization trust, as I said, is exempt. Now, if this income is exempt in the hands of securitization trust, as I said, these are pass-through entities. These are pass-through entities. Pass-through entity means that the income will not be taxable in the hands of trust, because trust is not a person. So any income which is received by the investor or accruing or arising to an investor from the securitization trust out of the investments made in the securitization trust shall be taxable in the hands of the investor. Are we getting this? So this income will be, so income accruing or arising from the securitization trust is taxable in the hands of the investors. And this shall be taxable in the same manner, in the same manner as if the investor had directly invested in the underlying assets.
Ma'am, it is a capital gain. It's computed under income under capital gain.
No, not capital gain. See, what they are saying is, they are not saying under which head it will be taxable. What they are saying is the way the income is characterized in the hands of the trust. In the same manner, the income will be characterized in the hands of the investor, as if the investor would have invested directly in the underlying asset. So let's say, for example, if the asset is generating the interest, it will be, let's say, income from other source. In the hands of investor also, it will be income from other source. If, let's say, the asset is disposed of by the securitization trust and there is a capital gain. So you're classifying it in the capital gain. For investor also, it will be capital gain. So the nature of the income paid to the investor shall be of the same nature and will be in the same proportion as if it has been directly received by the investor and not by the securitization trust. So basically, what they are trying to say is that the nature and characterization of the income, nature and characterization of income in the hands of the investor shall be of same nature and shall be in the same proportion as if it was received by the securitization trust. So why they are saying like this? See, securitization trust, let's say it has generated the total income of, let's say, around 10 lakh rupees. Right? Let's see. Now, this is exempt in the hands of securitization trust. Now, out of this 10 lakh, let's say the PGBP was 2 lakh. Let's say the IFHP was 6 lakh. And let's say the IFOS was 2 lakh. Right? Now, let's say there are 10 investors in the company, in the securitization trust. Right? Now, each investor is, let's say, getting 1 lakh as distribution. Now, this 1 lakh, which is there, it is not in the nature of dividend. This is not in the nature of dividend, so do not directly put it under income from other sources. What you will do is, you will distribute this 1 lakh to investor, but in the hands of investor, this will remain taxable in the ratio of 2:, or you can write 1:3:1, which is basically this ratio. Isn't it? So basically, what I'm saying is that 1 will be taxable under PGBP, 3 will be taxable under IFHP, and this will remain taxable under IFOS. So this 1 lakh straight away will not go to IFOS. The 1 lakh, the nature and characterization and the proportion of that 1 lakh will be same as if it is directly received by the securitization trust. Now, students, you will ask that how will the investor knows that what is the characterization of income in the hands of securitization trust? So for that, the securitization trust has to issue a statement. What is the statement? It will issue a statement. What is the statement? It will issue a statement. What is the statement? It will issue a statement. What is the statement? It will issue a statement. What is the statement? It will issue a statement. What is the statement? It will issue a statement. What is the statement? It will issue a statement. What is the statement? It will issue a statement. What is the statement? It will issue a statement. What is the statement? It will issue a statement. What is the statement? It will issue a statement. What is the statement? It will issue a statement. What is the statement? It will issue a statement. What is the statement? It will issue a statement. What is the statement? It will issue a statement. What is the statement? It will issue a statement. What is the statement? It will issue a statement. What is the statement? It will issue a statement. What is the statement? It will issue a statement. What is the statement? It will issue a statement. What is the statement? It will issue a statement. What is the statement? It will at the year end, providing the breakup of the nature and the proportion of its income with respect to different heads of income. Are we getting this point? Yes or no? Is this clear, students?
Ma'am, how will the trust earn from income from house property?
Let's say it is earning some rental income. It has, let's say, for example, some asset, which is immobile property. Let's say the borrower has taken the loan on immobile property. Now, immobile property is then again pledged by bank to the securitization trust. Now, in that immobile property, let's say there is some rental income getting generated. Now, this will be received by securitization trust. Are we getting this?
But what is that immobile property pledged is their own house in which they live?
I'm just taking an example. I'm not
Okay.
saying that it could be own house, it could be rental, whatever it is. I'm just giving an example that this is how the nature and the characterization will remain.
Okay, ma'am. Thank you.
Ma'am,
Okay?
but generally when we taken loan on a property, so property remain under the possession of the owner, right?
Not
Like
necessarily.
taking, not necessarily, because I'm just knowing about car loans, gold loans. But gold are deposited by bank, but
Yeah.
otherwise, like car loans, or we have a
See,
property like
sometimes what
resident.
happens is there is default, right? Whenever there is default, the asset goes to the bank or now to the securitization trust, right? Now, if it is with the securitization trust may itself, let out the property. So then in that case, there is a possibility that rental income may be generated on that property.
Okay, ma'am.
Yeah. Any other doubt, any question? Now, the securitization trust, which is there is a TDS obligation also on it. So when this securitization trust gives the income to the investor, if the investor is, it has to deduct the TDS if the investor is resident, then the TDS will be resident individual, and HUF. TDS will be 25%, right? If it is other resident, this will be 30%. In case of a non-resident, it will be at the rates in force. What do we understand by rates in force?
According to notifications.
According to the no. So rate in force means the rate either under the act or under the tax treaty, whichever is beneficial. So you can write rates in force means rate under the act or DTAA, whichever is beneficial to the investor. Are we clear about securitization trust? Yes or no? Any questions, any doubts regarding the securitization trust?
Clear, ma'am.
Clear? All of you clear? Yes?
And which is beneficial to investor means whichever is lower in that
Yes,
case.
whichever is lower, obviously. So sometimes under the tax treaty, the rate is lower than the act. So then you can opt for the rate which is there under the act or under the treaty. Are we clear?
Yes, ma'am.
Yes or no? So securitization trust which are there are a pass-through entity, the income from which will not be taxable in the hands of the securitization trust, but will be taxable in the hands of the investors. Yes, so investors will be paying the tax and not the securitization trust. It will be, of course, in the like manner and in the same proportion. Yes, any questions so far? Any doubt? Okay. So now what I suggest is we take a break early, because once I start with AIF, again, I will not be able to take a break. So let's take a break of 10 minutes now, and then we start with the AIFs, because once we then start with AIF, then there will be, the break will get delayed. We will be almost 7:45. So let's take a break at this moment, and then we continue after 10 minutes. Yeah. now. Again, let us understand what are AIFs basically, what are alternate investment funds. So again, for that purpose, we need to understand how does AIFs operate, what are different kinds of AIF which are there. So just a brief background about the AIF. Now, AIFs are regulated by SEBI. Again, these are privately pooled investment fund. So, it's more or less, you can say that these are like the, mutual fund companies. But in mutual fund, any public can subscribe, right? And buy the mutual fund units, which will then invest in the underlying shares of different companies. But AIFs are not like that. So, the AIFs operate in a very, very different manner. So AIFs are regulated by SEBI. These are privately pooled investment fund, incorporated as either, trust or company or body corporate or LLP, whatever you can say. There are different categories of AIF depending on what are the underlying investments. So for example, the category 1 AIFs which are there, they invest in startups, they invest in small and medium enterprises, they invest in any economically viable sectors. The category 2 AIFs which are there, they are investing in private equity funds, in the debt funds. Then category 3 AIFs which are there are basically, making the investments for short-term returns. So there are different kinds of AIFs which exist, right? So the individual investors, basically the AIFs have a huge ticket size. Ticket size by me is that the huge investment which is required from the investors side. So under the AIFs, what happens is these AIFs are established as the investment vehicle, as again a special purpose vehicle which collects the funds from the high net worth individuals. As I said, under the mutual fund, anybody, you and me can, buy mutual fund units depending on again our risk appetite, where we want to invest into. So depending on that, we have debt oriented mutual fund, equity oriented mutual fund, hybrid funds. We have different kind of funds. Similarly, we have AIFs, but in AIFs there are investments collected from sophisticated investors, which are basically the high net worth investors, usually Indian or foreign investors, which have a very high net worth, right? So AIF collects the investment from them and then invest in different assets, right? And as I said, there can be different kind of category of AIFs depending on where they are investing. For example, in the startup, if you're investing, it is the category 1 AIF, which is acting as a venture capital fund, right? Then there is category 2 AIFs. Then there is category 3 AIFs, right? So depending on that, the AIFs will be categorized. Now, how does the taxation of AIF works? Again, AIFs are considered as the pass-through entity. What do you understand by pass-through? That the income will not be taxable in the hands of the AIF. It will be taxable in the hands of the individual investors. However, here it is little different from the securitization trust. It's not completely same as securitization trust. So let us understand how the taxability works for the AIFs. So we can write taxability of AIF. Now, the taxability will depend on the nature of the income. The taxability of the AIF is dependent on what is the nature of income. If it is the income under the head PGBP, if it is income under the head PGBP, or if it is the other income, which is basically other than PGBP. So if it is income under the head PGBP, then for that limited income, which is there under the head PGBP, this AIF shall be taxable in its own capacity. So income from the PGBP will not attain the pass-through status. The income which is taxable under the head PGBP shall be taxable in the hands of the AIF. This is taxable in the hands of AIF. If it is other income, then it will be a pass-through in nature. So this other income, if it is there, this is not taxable in the hands of AIF. So here I am writing taxability in the hands of AIF, and then I am writing taxability in the hands of the investors. So as I said, if it is PGBP, then it will be taxable in the hands of the AIF. So if it is taxable in the hands of the AIF, the income which is accruing or arising to or received by a unit holder of AIF, which is basically that proportion of income which is chargeable under the head PGBP, shall be exempt for the investor. So basically, this income shall be exempt for the investor under section 1023 FBB. And the other income which is not taxable in the hands of AIF will be taxable in the hands of the investor, if the investments were directly made by the investor and not through the AIF. So taxable in the same nature and proportion as if directly received by the investor. So for the other income, the principle will operate same as securitization trust. But for PGBP, the income will be taxable in the hands of the AIF. Are we clear up till this point? Yes or no? Mic is on. Then you please put yourself on mute. Yeah. So for the securitization trust also, all category of income had passed through. Here we don't have like that. Under AIF, only the other income other than PGBP income will attain the pass-through status. But for the PGBP, it will be remaining taxable in the hands of the AIF. And therefore, the investor will remain exempt for the PGBP proportion. Clear up till this point?
Yes, ma'am.
Yes. Now here, there is something special about the losses. Here there is something special about the losses which was also not there in the securitization trust. So the losses which are there, if the PGBP loss is there, Now, PGBP income is taxable in whose hands? In the hands of AIF. So, therefore, if there are any PGBP losses also, these will also be taxable in the hands of the, these will be allowed to be carried forward and set off to the AIF only. Are we getting this point? So, if there is any PGBP loss, so if the income is taxable in the hands of AIF, the loss under the head PGBP also shall be allowed to be carried forward and set off at the level of the AIF. And this shall not be allowed to the investors. Right? So just write down losses allowed to be carried forward and set off by the AIF. Are we clear? And this is not allowed to the investors. These are not allowed to the investors. Now, what about the losses other than the PGB? So, if there is any loss which cannot be set off at the fund level, right? Which cannot be set off at the level of the fund. It cannot be set off against any other head of income also. Then, such loss would be allowed to the unit holders. So loss other than the loss under the head PGBP, loss other than the loss under the head PGBP would be allowed to be carried forward and set off by the individual unit holders. Are we getting this point? So the losses which are on the other losses other than the PGBP, that will be allowed to be carried forward and set off in the hands of the unit holder, but there is a condition. What is the condition? Units should have been held for greater than equal to 12 months. Then the losses which are not set off at fund level can be set off and carry forward by the unit holders. Therefore, if the units have been held for less than 12 months. What if the units are held less than 12 months? In that case, what would happen? Yes.
Carry forward and set off will not be allowed.
Yeah. So the act is silent relating to the permissibility or carry forward of those losses. It does not provide any treatment for that. So for more than 12 months, if you are holding, then it says that it is to be carried forward and set off by the individual unit holder. But if it is for less than 12 months, the act is completely silent on that. So we will say the losses cannot be carried forward and set off by the individual unit holders. Yes, are we clear about this? Yes or no? Any questions so far? Yes,
Excuse me, ma'am.
yes.
Ma'am, in securitization trust also losses will be carried forward. Losses can be transferred to investor.
See, for that, there is no specific provision unlike AI. It can be, but there is no explicit provision for that. Under AIF, there is a specific provision for that.
So what is the treatment of losses in that case,
See,
ma'am?
it is a litigative point one can take, but it is not something, since there is no explicit provision for that, there could be a possibility of litigation. So, since there is, an explicit provision under the AIF which is mentioned, which is not given in the case of the securitization trust. So although there are different kind of rulings which are there, that if there is a loss, then that loss will be recognized in the hands of the investor based on the same position that we take under AIF. But as I said, under AIF, at least you have a explicit provision to that effect, which is not there in the case of securitization trust. So that could result in a lot of litigation. Maybe, you can, at the assessment stage, you may not get the kind of relief, but you can always appeal at the tribunal and then see whether you are able to get the relief. Are we clear?
Yes, ma'am.
Okay. Any other question? So there have been a couple of judgments around that particular point, which have held that the losses then will be allowed to the individual investors or the unit holder. Yes. Okay, perfect. Is it clear for all of you? Okay. Now, if you see here, the tax rate of the AIF, what would be the tax rate? When I say that the PGBP will be taxable in the hands of AIF, what shall be the tax rate for the AIF? Yes, what will be my tax rates?
Ma'am, it's charitable trust rate apply here.
No. 30%, Mansha? What will be the tax rate, students? Will it be 30%? So see, AIF can be company, it can be firm, it can be other. It can be a trust mainly, right? So if it is a company, then you will have a tax rate of,
30%.
yes, if AIF is a company, then it can be 30%, it can be 25%, it can be 22%, right? If it is LLP, then it is 30%, right? If it is AOP, BOI, or a trust, then it will be maximum marginal rate, isn't it? So this is how the taxability will be. Yes, are we clear? Now, if it is given to if it is taxable in the hands of the individual investors, then there shall be again here also TDS applicable. So AIF will deduct the TDS when it makes the payment to the individual unit holder. In case it is resident, then at 10%. In case for others, it will be at the rates in force. So TDS will be applicable over here. Yes, is the taxation of AIF pretty clear to you? Okay, shall we solve one question on this?
Ma'am, what is the TDS question section?
194 LBB. TDS is under 194 LBB. For securitization trust, it is 194 LBA, and for AIFs, it is 194 LBB. You can write for this as well. This is section 194 LBA for securitization trust. Okay. So shall we solve one question on the AIF losses, right? So let me quickly share the screen of your module. We'll solve one question from the module itself. Yeah. The following are the particulars of income of 4 investments fund for previous year 24-25. Business income, capital gain, income from other sources is given. Compute the total income of the investment fund and each unit holder for AY 25-26, assuming that each investment fund has 20 unit holders, each having 1 unit held by them for a period exceeding 24 months, and income from the investment in the investment fund is the only income of the unit holder. If investment fund C has the following income components for AY 26-27, what would be the total income of the fund and the unit holder for that year? Again, they have given business income, capital gain, and other source. So let's start with fund A. And you have to tell me the answer. Fund A has capital gain of 16 and income from other source of 4. What will be the taxability?
Ma'am, it will be exempt for the AIF. यानी ये
Exempt,
वर्टिकली
yes.
हमें देखना है ना
Hmm?
वर्टिकली देखना है ना ABCD
Yes, yes.
It is other than PGBP, then it is taxable in the hands of unit holders.
Correct. It will be taxable in the hands of unit holder. So how will you tax in the hands of unit holder? There are 20 unit holders. So let's say for 1 unit holder, what will be the income?
It's 1 lakh.
It will be 1 lakh. Now this 1 lakh, if you see, will be taxable in the same proportion as it is in the hands of the AI. So this 1 lakh, if you see, it is coming in the ratio of 1:4, isn't it?
Yes, ma'am.
Right? So that 1 lakh also, out of 1 lakh, 20,000 will be taxable as income from other source and 80,000 will remain taxable as capital gain. Are we clear? So this 1 lakh will not be straight away going to the dividend. Out of this 1 lakh, you will put 80,000 in capital gain and 20,000 in the hands of in the income from other source. Are we clear? So see, in the question in the exam, there could be question like, it could be a total income question in the exam where you will have, PGBP calculations, you will have interest, all of that. And there will be just one such adjustment which will say that rupees 1 lakh is received from the AIF and the breakup of which is as under. So there what you will have to do is, if 1 lakh is credited to your P&L account, first you will reduce it from the P&L account only to the extent of that PGBP income. And to the extent of the entire 1 lakh you will reduce. Out of that 1 lakh, you will then allocate that 1 lakh in different proportions under different heads of income. Are we clear? What about B now?
Ma'am, 2 lakh is chargeable under the PGB AI and
Yes,
other was transferred to investor.
correct. Again, this 18 lakh which is chargeable to investors, again you will allocate in the same ratio of 7:2, right? So 70,000 will be taxable in the hands of the individual in the under the head capital gain, and balance 20,000 will be taxable under the head income from other source. This is 18 lakh. 18 lakh divided by 20 for each individual investor, it will be 90,000. Clear? Clear up till now?
Ma'am, can
Yeah.
you please explain again the taxability in the hands of as the ratio I can
Yeah. So
getting
this is
confused.
14 plus 4, 20.
Yes,
Sorry,
ma'am.
18. 18
18,
divided by
18.
20 is 90,000. So
Yes, ma'am.
90,000 will be taxable in the hands of individual investor in the ratio of 7:2. 70 will go to capital gain, 20 will be income from other source. Right?
Ma'am, is 7:2 ratio guess
14:4 is
14
7:2.
is to.
Yeah?
Yes, yes, ma'am. Clear,
Okay.
clear.
Yeah.
Thank you, ma'am.
Now what about C?
Ma'am, loss is 2 lakh is carry forward by AIF and other 6 lakhs is depend on the utilization of debt, 12 months condition,
Okay.
and 8 lakh is income. Ma'am, yeah, first we set off them also or not?
Will it be set off? First identify. First, talk about the business loss of 2 lakh. Where will you carry forward this 2 lakh or will you set off against the other source?
Carry forward.
You will carry forward or you will set off. Can business losses be set off against income from other source?
No, ma'am.
It can be, right?
Yes, ma'am.
No
Normal
prohibition
business
on the
loss can
business
be
loss.
set.
See,
No,
if
no,
it is
no.
a brought forward business loss, then it cannot be. Yes, Mansha, right. If it is a brought forward business loss, then it cannot be. But if it is the loss of the current year, then first you do the intra-head set-off. Then you do the inter-head set-off. If the inter-head is also not done, then you will carry it forward in the next assessment year and set off against the PGBP income. This is not a brought forward loss. This is a current year loss. So this can be set off against IFOS students. Had it been a brought forward loss, you could have said, okay, we cannot set off against the other income. We can only set off against business income. But this is a current year loss. So we can set off against the income from other source. Yes or no? So this 2 lakh will not be carried forward. This will be set off against the 8. Are we clear? Yes or no?
So, ma'am,
Ma'am,
here in this year,
capital.
zero income is there?
How zero? See, capital gain, we have a restriction. The loss under the head capital gain cannot be set off and carry forward against any other head of income, even for the current year.
Okay.
For business, we don't have any such restriction. Under 72, you don't have restriction. Under 74, you have a restriction that the short-term capital loss can be only set off against the short-term capital gain or long-term capital gain. Long-term capital loss can only be set off against long-term capital gain. Right?
Yes, ma'am.
So 6 will be carried forward by the unit holder. And 6 rupees, 6 lakh rupees, 8 minus 2 of the business income. That 6 lakh will be taxable in the hands of unit holder in this year. So 6 lakh divided by 20, how much it will be? This will give us 30,000, which will be taxable in the hands of the unit holder under the head income from other sources. Are we clear about this position? Yes or no?
Yes, ma'am. Clear.
Yes, clear?
Yes, ma'am.
So, this loss is being carried forward under the capital gains by the individual investor because he has held the unit for more than 12 months. Now, if you see, there is an additional adjustment which is put over here. If the investment fund C has the following income components for AY 26-27 next year, what would be the total income of the fund and the unit holder for that year? Business income 2 lakh, capital gain 9 lakh, and income from other source 8 lakh.
Ma'am, business income is taxable and in the hand of AIF.
Correct.
Yeah, ma'am. And this capital gain and income from other sources is pass over to investor.
Yes.
And if there is any previous loss, then they adjust it otherwise accordingly.
Correct. So the previous loss was 6 lakh. Right? The previous loss was carried forward by the individual investor. So this 6 lakh will be set off against this 9 lakh. Right? So in the hands of the individual investor, 30,000, 6 lakh divided by 20 unit holders is 30,000 loss of each individual investor. And there is a gain of 9 lakh divided by 20 for each individual investor, isn't it? So therefore, for the each individual investor, out of 45,000 gain, 9 lakh divided by 20, you will minus 30,000. So balance capital gain in the next year will only be 15,000. And income from other source will be 8 lakh divided by 20, which will be 40,000. Are we clear about this?
Excuse me, ma'am.
Yeah.
Ma'am, in a hand of investor, like I am invested in AIF, okay? I receive a loss of capital gain like previous this year, current year, 30,000. So if I have any other capital income, so can I set off this? Okay.
Yes, you can do it.
So in this condition, ma'am, now we are deduct TDS on 9 lakh plus 8 lakh accordingly, right?
See, TDS, yes, will be on 9 lakh plus 8. No, TDS will be on the total income which is distributed. So here they have not given what is the distribution amount.
Yeah, but ma'am, my question is that we have not consider last year a carry forward loss, right?
No, you will not. See, TDS, it's on the gross amount only. So if you, let's say, for example, you are straight away distributing to the unit holder 9 plus 8 plus 2, right? Which is somewhere close to 19 lakh. So on 19 lakh, you will deduct the TDS. So TDS is on the gross amount irrespective of what is the tax treatment.
Yes, ma'am.
Okay. Is this clear? So this 6 which is there is carried forward to the next year. So this will be set off against this 9 lakh. So only 3 lakh divided by 20, which is 15,000 taxable in the hands of each individual investor as capital gain, and income from other sources will be 8 lakh divided by 20, which is 40,000. Yes or no? Is this clear?
Ma'am, it'll be LTCG, right?
It is not given whether it is LTCG or STCG. It's just said in the question it's capital gains.
But ma'am, that the period of holding is more than 24 months.
No,
That we
see,
shouldn't consider.
no. This is for the unit holders period of holding. This capital gain is of the AIF, which is taxable in the hands of unit holder. It is not the capital gain on sale of units of the unit holder. This is the capital gain which is earned by the AIF, which is passed through in the hands of now the individual unit holder.
Okay, ma'am. Okay.
Yeah, don't get confused here. This is not the capital gain of unit holder. Clear, students? Yes? I'm not getting answers. Is this clear?
So when we sell this unit, it'll be considered as the sale of units in the business trust. That only, right?
Yes. Any other doubt, any question? You can ask as many questions as you have until you are clearer. Yes? Are we clear?
Ma'am, can you show the answer how we write that in a second year, like assessment year
Yeah, it's
2016?
just
How
a
we
note what they have shared. For AY 26-27, brought forward capital loss of 30 can be set off against capital gain of 45. Since the period of unit of holdings is 24 months or more, business income would be taxable in the hands of investment fund and income from other source would be taxable in the hands of unit holder.
okay.
Clear?
Yes.
Any other questions? Any doubts, students?
Yeah,
Yes? Okay. Last one, D. 5, 20, and 2. What we will do?
Ma'am, we first set off these 2 lakh from 5 lakh. 3 lakh is
Correct.
our business income,
Correct.
and 20,000 is goes to 20 lakh goes to investor.
Correct. Absolutely. So do not make a mistake of carrying forward this 2 to the individual investor because you can do a set off here. So see, it is only if the losses are not able to set off at the fund level. Only then you allow them to the individual investors. So first try and set off in the fund. If it is not possible, then only it will flow to the individual investors if it is other than PGBP loss. Clear, students? Is AIF concept pretty clear to you? Shall we move to the next topic?
ma'am, it is very much different from the normal trust.
Yeah, it is different from the normal trust. Absolutely. So all the 3 trusts that you will see, for example, now we will move to REIT. REIT has a completely different way of taxation. Securitization trust was the simplest one. AIF is little trickier in terms of the losses set off because for PGBP, you have the taxability in the hands of AIF. For other income, it is taxable in the hands of the unit holder. Now, when you move towards the REIT, it is altogether in a different way. And then for the charitable trust, we will see how the concept is entirely different from how we are dealing with these kind of trust. Okay. Charitable trust is in fact more trickier. Are we clear? Shall we move to the next topic?
Yes, ma'am, clear.
Yes,
Okay.
ma'am.
So let's move to the REITs now. But see, my request to you would remain the same that please solve as many questions as possible. Please keep revising because otherwise DT will become the toughest subject for you, which should not be the case because it's entirely based on logic. And if you are able to understand the concepts, you would be able to score very good marks under direct tax. It's a very scoring paper and it's not at all a difficult paper. So make it your strength rather than weakness.
Ma'am, normally DT question is a theoretical part is more or in a practical part are more in a paper.
See, in the paper, the theory part would be less and the practical part would be more. You can expect a lot of total income questions. At least the first 2, 3 questions are on the total income. You can easily expect a question, full-fledged question on total income. You can expect questions on MAT and total income, AMT. So PGBP remains a very important area. Partnership firm remains a very important area. Then there could be a smaller set of questions on capital gain. There could be capital gain integrated in the total income sums. So more or less, it would be a practical paper. It will not be a very big theory paper. Of course, the theory questions are very less, which test again on the assessment procedures, appeals, search and seizure, all of those areas. But apart from that, it's going to be the number computation paper. So that's why I'm saying I'm emphasizing time and again that you have to keep revising, you have to keep solving the questions for DT. The presentation in DT is very critical because even if you write a right answer, the chances are you will not get full marks if your notes are not proper, if your presentation is not proper. you will lose out on marks. For example, it's very simple to say that if I have not deposited the employee's contribution to the PF within the due date of the fund, I will disallow it. But it's not like that. I have to first add it to the income. And in case I have deposited by the due date of fund, I have to reduce from the income under section 36. If I have not deposited, then it will only remain as income. So don't try just disallowances. You have to show that it's an income and then we get the deduction under 36. And the deduction will not be available if the amounts are not deposited by the due date of fund. So see, the presentation becomes very, very, very critical. If you make a wrong presentation, you will lose out on marks. So that's the reason you have to understand the concept. You have to understand and make a presentation. The more you will read, the more you will be able to produce your answers in a better way. Don't go for shortcuts. There are no shortcuts to any paper in your CA final. You have to emphasize on the presentation for each and every paper, but direct tax is one of the critical paper where presentation is very important, because for every adjustment that you make, you have to write notes to it. And I will suggest invest in good books, invest in your module to read out from that. Do not rely on only these pictorial presentations that I'm sharing with you. This is just for the purpose of your revision, not for your main preparation. There are no shortcuts, remember that. You have to take act into consideration and read from the act. And then do as many practical examples as possible. There are a lot of past exam questions. There are a lot of other practical problems that you can get. So you have to invest time in that. There is no way you can get, easily out of direct tax if you do not practice. Clear?
Yes, ma'am. Thank you.
Okay. Mansha, you have old study material. You have to buy a new study material because the Act has undergone the change because of the Finance Act 2024 amendments. You cannot read from the old study material. You have to buy the new ones.
But ma'am, the
Direct
study
tax is
material,
important. Yes.
study material is not available this time
It's
physically.
available on the website, right?
Yeah, website PDF format is there.
So see, what I will suggest is students, please do not wait for the study materials to be released and distributed as books, or you have to buy it. You can just take the printout and get started with the chapters. At least you have started reading on, because by the time the study material may be available, it might be too late. So do not wait for that. And
Yes,
I
ma'am.
will suggest invest in good books also. There are a lot of professional books also for the direct tax, for even other subjects where you will get a lot of practical problems. So please solve those. It's very important. It will be available from first week of January. Ankita has some information. She's saying it will be available from first week of January for delivery. But see, for May examination students, we are already in the month of December, right? So you
Yes,
are
ma'am.
technically left with another 4 months. Now, 4 months are very short, at the same time are enough also if you have to, prepare. Now, you will get, let's see, Christmas vacations where you do not have many lectures during that time. You may have some, but not that many, right? So during that time, utilize your time wisely. Do not spend your time on just, the festivals. You have to forget every kind of festival which is coming your way, any weddings are coming your way, any kind of events which are coming your way. We have to make these sacrifices. We have signed up for this course willingly, right? And we have to be prepared for this. You have to at least spend 14 to 16 hours daily to study. Make a timetable, decide how much in the day you want to cover up. Stay away from social media as much as possible, because this will otherwise impact you on your studies. Unless and until you are not ready to make sacrifices, please do not think that you would be able to clear this exam easily. It is, you get something only when you sacrifice. So you have to do that. And for that, I think, you have to put your time and not see, studying is not you have to just take a book and read for 14 hours. That's not how it has to be. It's a professional exam. You have to practice a lot. The more you would practice, the more you would be able to solve the final exams. Clear?
Ma'am,
Yes.
when you were in your finals and maybe you have the office and other work also, then how you maintain your study?
See, you have to, I think, manage that balance. I remember my days during my articleship. I used to wake up at around 3:30 in the morning. I used to start my days, and living in the city of Bombay, where everything is, around 1.5, 2 hours easily away from one place. My coaching used to be around 1.5 hour away from my place. My articleship place was another 2 hours away from my coaching institute. So I used to therefore start my day at 3:30. I used to take up the subjects which are very difficult, which I am finding most difficulty with, to deal with those papers in the morning time, so that when my brain is fresh, I could devote my time on that. Then basically I would spend time another half an hour before I leave for my coaching used to start at around 7 in the morning, so I had to leave my home by 6. So what I used to do is, during my travel hour also, the 1 hour that I'm spending in the trains also, we never had a seat to sit on.
Yes.
We used to just stand, and in that 1 hour I used to revise what is going to be happening in the class and what happened one day before. So if the class is, let's say, on direct tax, I would revise what had happened in the previous class, so that I'm already aware about it, and therefore it will give me a link. Otherwise, you get lost with the link if you have different subjects during the classes. So you have to keep revising. So during that 1 hour, I used to revise my previous class. Then again, when 10 o'clock, my class used to get over. During the train time, I again used to, sit and do the reading of what happened in the class today. And then again, coming back from articleship, I used to again spend time doing my sums of maybe FR, SFM, because I was almost tired throughout the day. Now, again, when you solve the sums, you don't feel really tired because
Yes.
you're not reading any theory. So you have to, spend and manage your time wisely as much as possible. I understand during the deadlines, it is not possible to devote that much time, but whatever is possible, you have to do it. There is no break, there is no rest. This is what, CA is. And then you have the entire life with you to enjoy howsoever you want it. But this is something that we need to clear because we have signed up for the course and we have willingly done that, right? So be prepared to make these huge sacrifices, because once you make it, that's the amount of success that you will get at the end. Yes, Ankita, 3:30, because you have to devote that much time. Okay?
Yes, ma'am. Thank you, ma'am.
Yeah. Thank you, Mansha. Please do not idealize me. I mean, it's just that, every CA student, I think, does it, and you have to do it because there is no shortcut, as I said. And, once we have entered this gate, there is no way back. Now you have to just, cross that gate. And now, whatever it takes to cross that gate, you have to do it. So let's not waste time and let's start with REIT. Okay. Otherwise, I'll be scolded if I do not finish this. Okay. Now, what are these REITs or InvIT students? So, REITs are real estate investment trust. Now, these REITs are very different from your securitization trust or AIFs. Here, the underlying securities is the immovable property. Again, students, REITs which are there are registered with the SEBI. So, under REITs or these infrastructure trusts which are there, basically the InvITs which are there. Thank you so much, Mansha. We'll hope to meet soon. So the REITs which are there are basically the trust which invest in the underlying assets in the immovable property. Are we clear? So again, these are registered or set up as trust and registered with SEBI. So two kinds of trust are there. One is real estate investment trust and second is the infrastructure investment trust, which is in. Now, how do these REITs operate? Let us try and make a presentation here to understand how the REITs are operating and what will be the kind of income for the REIT. Are we clear? So in the case of the real estate investment trust, this REIT, as I said, is incorporated as a trust. And there is a possibility that the sponsor of the special purpose vehicle is there. So let's say there is a special purpose vehicle which is there, which is basically a company. Now, there is this REIT which is getting incorporated, right? So basically, there is this sponsor, or you can say the shareholder of the SPV. Now, how will we incorporate this? Now, this REIT will hold the investments in the SPV. So technically what will happen is, students, please be very careful and attentive over here. When this REIT is made the shareholder of the existing SPV, SPV is a special purpose vehicle. It's a company. Special purpose vehicle means it is incorporated with an intention to hold some underlying investment. Your immovable property will be the underlying investment. Now, this shareholders of SPV, the promoters of the SPV or the sponsor of the SPV, in order to make REIT as the shareholder, will give their shares or will transfer their shares to the REIT. Isn't it? The sponsor will transfer the shares of SPV to REIT, then only the REIT will become the shareholder. Yes or no? Is this clear? Yes or no, students? Are we getting this?
Ma'am, repeat once again.
Yes. Thank you, Ankita. Yes. So, at this moment, there is a special purpose vehicle, which is a company, is existing. I want to make this REIT hold the investments in SPV. Because as per the SEBI regulations, the REIT can invest in real estate only directly or through a special purpose vehicle. Are we getting this? So a REIT shall invest in the commercial real assets either directly or through a special purpose vehicle. Now there was this already existing SPV which is holding, let's say, the investment in the immovable property. Now the shareholders of this SPV want this SPV to be held by a REIT. So what they will do is they will give up or transfer their shares to REIT. Clear? Yes or no? Only then the REIT can become the shareholder of SPV, right? Yes or no?
Yes, ma'am.
Correct? Now they will transfer the shares of SPV and in return, they will get units of the REIT. So by giving up their shares to the REIT, in return, they are getting the units of the REIT. Now this transaction, what it should attract according to you? Transfer of shares of SPV, what it should attract?
Capital gains.
Correct, capital gains. But this is not regarded as transfer under section 47. So under section 47, this is not regarded as transfer. So meaning there is a specific exemption to this effect. So transfer of units by the promoter or exchange of shares in SPV for the units of business trust is not treated as transfer. And therefore, the capital gain will not get attracted in this case. Are we clear up till this? Yes or
Yes,
no?
ma'am.
Right? So, since this is not regarded as transfer, there shall not be any capital gain to this effect. So, this is a specific exemption which is coming up. Clear? Now, what will happen is when this REIT, which is getting the shares of this SPV now, I have told you a very, very important point over here. Under the mat, that on this transfer of shares of SPV for the unit of business trust, if the promoter is also another company, quite possible that this shareholder may be a company,
Yes, ma'am.
right? So when this company is transferring the shares of SPV and getting the units of REIT, there may be a notional gain or loss which may be arising, right? Now, this may be included in the book profit. Yes or no? Yes, are we getting this? Are you in line with me?
Yes.
Yes or no? This may be included in the book profit. Yes,
Yes, ma'am.
right? So I had told you under the MAT chapter, if you see here, what we have done, notional gain on the units of business trust. So notional gain or loss on the transfer of shares of SPV to a business trust in exchange of units allotted by the business trust shall be reduced or added, because this is a notional gain or loss. So if the gain is credited, we will reduce from the book profit. If the loss is reduced, we will add back. And in fact, we will take into consideration the actual gain or loss on the sale of the units of business trust. So when the business trust units, when the REIT units will be finally sold by the promoters, at that time, whatever gain or loss will arise, that we will take it into consideration in the book profit. So at that time, I told you to leave this adjustment and we'll touch base on this later. And we are touching it at this point in time. Are we clear?
Yes, ma'am.
So therefore, you will write here, reduce from the book profits for MAT calculation when units of REIT are actually sold actual gain or loss shall be added or reduced to the book profits. Are we clear, students? Yes or no? Is this point clear?
Yes, ma'am. Clear.
Fine. Okay. Now, let's say, for example, let's say for example, if the units of the REIT are sold, if the units of the REIT are sold, what will happen? There will be a capital gain, right? Now, what will be the taxation of that capital gain, students? When these units are sold by the REIT, sold by the unit holder. There shall be capital gain. What is the period of holding for short term and long term?
12 months.
Sorry?
12 months. Or
12 months. If the transfer takes place before 23rd July 2024, it used to be 36 months. And after 23rd July 2024, it will be 12 months. So, the period of holding under section 242A, if it is before 23rd July 24, 36 months. After 23rd July, this will be 12 months. Now, what will be the taxability of the short-term capital gain and long-term capital gain? Yes. Thank you, Ginny. We'll meet soon once you become CA for sure. All the best to all of you.
And there is also one condition of 1 lakh is apply. More than 1 lakh, 10%.
Yes, but now we have 1.25 lakhs.
Okay.
Right? Now we have the 1.25 lakhs, which is there under 112A. So, long-term capital gain will be taxable under 112A if the long-term capital gain exceeds rupees 1.25 lakh. The tax rate will be before 23rd July 24. How much was the tax rate?
10%.
Correct. And after 23rd July 24, what is the tax rate?
12.5.
Yes. What about STCG?
20%.
Ma'am, before this is, I think, 15%.
Yes. So before 23rd July and after and remember or do not forget this point here. When the units of REIT are actually sold, actual gain or loss shall be added or reduced to the book profit if the unit holder is a company. Right? Are we clear about this? Yes, students, is this clear up till this much? I'm not getting the answers. अभी start हुआ है read. Clear? Yes or no, all of you clear?
Ma'am, can you explain this line you have added once again, the related to MAT?
Yeah, so what I said is I've just written the line here for the clarity that when the units of the REIT are actually sold, the gain or loss shall be added or reduced to the book profit at that point in time, and the notional gain or loss which had arisen on the exchange of units of shares of SPV for the units of REIT at that time, there will be addition or reduction from the book profit. So notional
Yes,
gain
ma'am.
or loss is not to be considered in the book profit. It is the actual gain or loss that you have to add or reduce from the book profit. Clear?
Yes, ma'am.
Ma'am,
Clear.
but second line, it's already adjusted in a book profit, so there is no impact of that. Actually, if we solve that,
No. See, what will happen is when this shares of the SPV will be exchanged for the units of REIT, at that time you will record a notional gain or loss in their book profit. So that is what I'm reducing or adding here from the book profit. So when the actual gain or loss will occur, at that time you will not recognize in book profit because you have already recognized as a notional gain or loss. So when you will have an actual gain or loss, that you will have to separately recognize. Is that clear?
Clear, ma'am.
okay.
Mitali, clear?
Yes, ma'am.
Okay, perfect. Now let us take a step forward about the taxability of REIT. See, till now what we understood is the taxability of the unit holder. Now we are moving towards the REIT, right? Now, with respect to the REIT, what is the taxability? So, for that, we have to understand what is the nature of income of the REIT. As I said, the REIT will either hold the immovable property directly or it will hold through a special purpose vehicle, right? Because the REIT has to invest in the immovable property. So either it will hold directly or it will hold through a particular SPV. Okay, before we go on to the REIT, I missed one point here. One second. Yeah. Tell me one thing. What will be the cost of acquisition of the REIT units for the sponsor?
Ma'am, what is the cost to sponsor? That was ultimate cost of acquisition of REIT.
What is the cost to the sponsor for the REIT will be the cost of acquisition of shares of SPV,
Yes,
right?
ma'am. Yes,
So
ma'am.
they have acquired the units of REIT through exchanging the shares of SPV. So the cost of acquisition of REIT units will be the cost of acquisition of shares of the SPV. Are we clear? And in fact, for the period of holding also, you will club the period of holding of shares of SPV. Yes or no?
Yes,
Yes?
ma'am.
All of you, yes or no? I need yes from all. Yes?
Yes, ma'am. Clear.
Okay, perfect. Now, understand here with coming to again the REIT. Now, when I say that REIT is investing in the immovable property or in the SPV. Now, there is a possibility when I invest in the immovable property directly, what kind of income you may generate out of immovable property? What kind of income you can generate from the immovable property, students?
Rent income, ma'am.
Correct, rental. That's the only income, right? So, rental income of the REIT from directly owned real estate. So, any income which is earned by way of renting or leasing or letting out under which head you will tax?
House property.
Ma'am, it's a business income.
Have you done the case of Chennai properties? Yes?
Yes.
What was it saying?
Any rental from even commercial properties will be charged under the head income from house properties.
No. Chennai properties case is all about that if my business, yes, Mansha, right? If my business is to hold and let out the properties, then in that particular case, the income will be considered as the business income and not IFHP. So, if I'm into the business of investing in the real estate and generating the income therefrom, if this is my business, then it will be considered as the business income. So, Supreme Court in Chennai Properties, in Raila Corporation, what they had observed, that if the holding of the properties and earning the income by letting out of the property is the main objective of the company, then it will be considered as the business income.
Ma'am, here you particularly use the word company. So it's the entity or it's apply on a company only.
It is entity, any entity. However, this Chennai property case, which was there, is now overridden by the Finance Act 2024 amendment, which has been made to Section 28. What was the amendment? Go to your PGBP class and tell me what was the amendment. Yes.
Any rent will be chargeable under income from house property.
Not any rent. It is hereby clarified that any income from letting out of a residential house shall not be chargeable under the head PGBP and shall be chargeable under the head income from house property. Yes. Are you getting this amendment? So if the income is from the residential house, irrespective if you are into the business of renting out, it will be IFHP and not PGBP. But if it is from the commercial property, then if you are into the business of letting out the shops based on Chennai property, you can take a position that it will be chargeable under PGBP and not under IFHP. It is not that if you are renting out the commercial space, always it will be PGBP. It will still be IFHP. But if I'm into the business of renting out the commercial space, then only it will be PGBP. So this was a question which was asked 2-3 years back in the CA final exam on the REIT, where that was a very complicated question you will find in one of the past exams, where not only this Chennai property case was tested, also ICDS 3 was also tested. What is ICDS 3? ICDS 3 students, what was it? Construction contracts, isn't it? So that was a very good sum which was tested. So you have to be very clear, see about the principles. What you have learned under PGBP, it's not only relevant for PGBP, it can be relevant here also. So when you are investing in directly in immobile property, what you will generate is the rental income, right? If it is from the residential house, then this will be chargeable under the head IFHB. Explanation 3 to section 28. Are we clear? And if this is commercial property, this will be PGBP, since REIT is in business of investing in house property and generating rental income. So, Chennai Property Supreme Court judgment will be applicable. Are we clear, students? Yes or no? Yes.
Ma'am, it is a optional that if I am in a business of lending out the property, so I consider this Chennai case, or it's a compulsory that
See,
if it's gone in a business and a
it
professional.
is always beneficial to consider this as business, no? I mean, see, under business, you can claim depreciation, you can claim interest, you can claim other, maintenance expense of the property. But in case if you consider IFHP, you are just getting standard deduction and interest. So, people will want to push for the PGBP. Nobody will say, I want to go for IFHP. In fact, the income tax department will say you go for IFHP because income tax department does want to, get more tax out of you. So they will, try to restrict the deductions only to standard deduction of 30% and interest. That's it. But you will claim, more deduction to reduce your tax liability. So nobody will want to go for IFHP, right? So it's an optional only, but people will obviously go for this.
Okay.
Correct?
Okay.
Yes, is this clear? Yes or no? Not getting answer.
मैम
Yeah.
अगर
Ma'am,
अगर कोई पर्सन हाउस प्रॉपर्टी को रेंट पर दे रहा है, यानी रेसिडेंशियल हाउस प्रॉपर्टी एक से ज्यादा है, उसका भी यानी यही काम है देना, तो ये भी बिजनेस ही कंसीडर करना चाहिए ना?
बट अभी स्पेसिफिक एग्जेम्पशन है ना. अभी इनिशियली वी यूज्ड टू क्लेम लाइक दैट एज पर चेन्नई प्रॉपर्टी फॉर रेसिडेंशियल आल्सो.
यानी
बट
इसमें कितने
या
भी हाउस प्रॉपर्टी हो तो भी यानी आईएफएचपी में ही कंसीडर करेंगे?
यस, बिकॉज
ma'am,
नाउ
but
स्पेसिफिक explanation which is introduced which says that we will consider it as a house property income.
ओके मैम.
Yeah.
ma'am, if a case is that it's like this explanation is come after 31st July 2024, right?
Yes.
So if a person have a income before that, means in a month of April, May, and June, so it can consider in a business and professional income, or it's apply on all over.
See, the explanation is introduced. Now, purpose of explanation is to clarify something, right? And it also says it is hereby clarified. So, when you say it is hereby clarified, meaning that the position has always been this, and now we are just, specifically putting this out. So, most of the time when it's a clarificatory amendment, the revenue tries to apply it retrospectively.
Okay, ma'am. Thank you.
Okay. Now, what will be the taxability of this rental income? So, where the rental income is received directly by the real estate investment trust, this is exempt in the hands of the trust. So, this will be exempt in the hands of REIT under 1023 FCA. Right? And when it is given to the unit holder, this will be deemed to be the income of the unit holder. So, for the unit holder, this will be taxable in the hands of the unit holder. Are we clear? And on this, there will be TDS under section 194 LBA. So for resident, it is 10%. For the non-resident, it will be rates in force. And when this rental income will be received by the REIT, here there will be no TDS. So the person who is paying the rent will not deduct TDS under 194I. When the REIT pays it to the unit holder, at that time, there will be the taxability which will be there. Are we clear about this aspect?
Ma'am, it will same treated as in a hand of investor or we say
In the
unit
like
holder
manner,
like
yes.
residential income and is HP income and otherwise is the profit.
Yes. So in the hands of the unit holder, again, this is a pass-through entity. So whatever you have learned the concept for securitization trust for AIF, it is similarly applicable over here also. So any distributed income which is received by the unit holder will be subjected to the same nature and proportion as it was there in the hands of REIT. Are we clear? So this is a pass-through income, meaning it will be taxed in the same proportion as if it was received by the unit holder directly. Are we clear?
Ma'am, here is a specific mention about the loss carry forward or not?
No. Here also there's no specific mention about the loss. That's only in the case of AI. In the hands of unit holder, the income distributed by the REIT shall be deemed to be of same nature and proportion as received by the REIT. Are we clear? Yes.
Yes,
Any
ma'am.
questions? Yes. Okay. Now let's move forward. Now, if the REIT is investing through the SPP, it is not receiving the amount directly. It is not investing directly. It is receiving through the SPV. Now, when it invests in SPV, what could be the mode of investment in SPV? Yes. Either it could be through the shares or through the debt, right? Either it could be through the shares or it could be through debt, right? How
Yes,
can
ma'am.
otherwise a REIT invest? So either it can be shares or through the debt, right? Now, if it is invested in shares, how can the SPV distribute the returns? by way of
Dividend.
dividend, right? Now the dividend which is received from the SPV, the dividend which is received from the SPV, which is there, the taxability of that dividend is important. So dividend which is received from the SPV by the business trust would be exempt in its hands. So this dividend would be,
Excuse me, ma'am.
yes,
Are you writing in the notes?
yes,
Now visible.
okay, exempt in the hands of REIT. This dividend will be exempt in the hands of REIT, meaning your SPV will not deduct also TDS under section 194. Are we clear? Now, when this income is in the nature of dividend, is distributed to the unit holder, there are two things we have to consider. So in the hands of the unit holder, one second, let me make it a little simpler. In the hands of unit holder, you have to see whether the SPV has exercised the option under 115BAA. What is 115BAA? What is 115BAA?
Ma'am, concessional rates for companies who are in manufacturing,
Not manufacturing.
generating power, generating power.
No. This is a concessional rate other than for the manufacturing, which is 22%.
Yes, ma'am.
Right? So whether the SPV has exercised the option under 115BAA. If the answer is yes, only then dividends taxable in the hands of the unit holder. Only then the dividends will be taxable in the hands of the unit holder. In that case, the tax rate will be, if it is a resident unit holder, this will be normal rates of tax, and if it is non-resident share unit holder, this will be 10%. Are we clear? Yes or no?
Ma'am, here TDS is deductible and
Yes.
by whom? By whom?
TDS will be deductible by the REIT only. TDS will be deductible by the REIT only. Okay. So here there will be TDS under section 194 LBA. For a resident, this will be 10%. For the non-resident also, this will be 10%. And if the SPV has not exercised the option, if the SPV has not exercised the option under 115BAA, then dividend not taxable in the hands of unit holder, plus there will not be any TDS. So if the SPV does not exercise the option under 115BAA, meaning SPV does not exercise 22% tax rate, in that case, it will be not taxable either in the hands of the unit holder or in the hands of the REIT.
This is exemption or it's a not taxable income?
This is not taxable income. In the hands of the REIT, it is exempt under 1023FB. But in the hands of the unit holder, this will be not taxable. Are we clear?
Yes, ma'am.
Okay. Any questions, any doubt till now? Are we clear? Now see, I would like to highlight one point over here with respect to the tax rate which is there for non-resident. Now, your dividend income which is there, if the SPV has exercised the option under 115BAA, then for the unit holder, this is going to be taxable, isn't it? Now, at what rate it is taxable? So, this income which is there is taxable at the rate of, what is the rate applicable for the dividends? Now, in your module, they have given a tax rate of 10% for the non-resident. I'm not talking about resident. Resident, any which ways they are saying it will be taxable as per the normal rates of tax. Right? But for a non-resident, they are saying that alternatively, under 115A, which provides for the tax rate of dividend, that dividend is actually taxable under 115A at 20%. But they have taken an interpretation that the TDS cannot be lesser than the tax rate. And therefore, ideally, the tax rate of 10% should be applicable. So, there is no clear backing to it. So, this is a clearly litigative area where one can take a position that actually dividends are taxable under 115A at the rate of 20%, and therefore the 20% rate should be applicable. Are we getting this? Okay. So, in that particular case, the 20% rate can be applicable.
So, ma'am, in an exam, how much we show that it's a 10%?
You should write an alternative answer. You should write 10% and alternatively you can take a position of 20% in exam. Okay? Perfect. Now, this is one option of SPV distributing the return. What is the other option? If the REIT invest in SPV through the debt, what will be the return that the SPV will give?
Interest income.
Interest income, right? So now, about the interest income. So when interest income of the business trust is received from the SPV, again, the interest income is not taxable in the hands of the business trust. So, if the SPV gives the interest, You can put an asterisk mark and write here down. Again, this is not taxable in the hands of REIT under section 1023 FC. And SPV is not required to deduct TDS under section 194A. Now, the income will be taxable in the hands of the unit holder. Now, what will be the tax rate for a resident unit holder? Normal rate of tax. For a non-resident, 5%. And there will be TDS under 194 LBA. For a resident, it will be 10%. For a non-resident, it shall be 5%. Are we clear? So this is about the interest, which is paid to the paid by the SPV to the REIT. Are we clear? Now, beyond that, it is also possible that the SPV has, let's say, or REIT has borrowed certain funds from third parties. So, quite possible that the REIT has taken the funds it has borrowed the funds from, let's say, some non-resident. In that case, the interest payment which is being made to these non-resident on the external commercial borrowing, the REIT is required to deduct the TDS at the rate of 5%. So on this, TDS under section 194 LC will be 5%. Are we clear? And if this is if this particular funds are borrowed through the rupee denominated bonds listed on IFSC, then in that particular case, it will be 9%. Are we clear? So if borrowed from or borrowed through rupee denominated bond listed in IFSC, TDS is at the rate of 9%. Are we clear? Last, if let's say, for example, there is capital gain on the sale of the property by the business trust or any assets. So if there is any capital gain income on sale of capital asset by the REIT, what shall be the taxability? So capital gain in case of long-term capital gain, it will be 112 or 112A. If it is a short-term capital gain, it will be 111A or Other will be taxable at maximum marginal rate. Are we clear?
Ma'am,
So, yes.
Ma'am, in a case REIT now sell the SPV, we say that shares, then what? Then it is also considered capital gain.
Yes. If you sell any capital asset, it will be capital gain.
Yeah. Okay.
Okay. So what they say is, in case of long-term capital gains, the provision of 112 will be applicable. In case of short-term capital gain, 111A, and in case of other than 111A, it will be maximum marginal rate. Are we clear?
This will be taxable in the hands of the trust, right?
Yes, in the hands of the trust.
Then what about the unit holders?
It will be exempt.
Okay.
It will be exempt in the hands of unit holder. Okay. So you can just write down taxable in the hands of a REIT. In the hands of unit holder, this is exempt. Last is, in case there is any other income which is earned by the REIT, then in that particular case, it will be taxable at the maximum marginal rate. And in the hands of the unit holder, it will be exempt. So you can write any other income taxable at MMR in the hands of REIT, and for unit holders, this will be exempt. Are we clear? Yes or no? Any doubt, any question?
Ma'am, why you have removed the section 112A?
Yeah, because if you see here, let me show you the act. This is an anomaly in the act which is there. See, this is 115 UA. It says subject to the provision of 111A and 112, the total income of business trust shall be charged to maximum marginal rate. So it only says that other than 111A and 112, it does not refer to 112A. So that's the reason why I have removed 112A there. So long-term capital gain other than 112 will be taxable at maximum marginal rate. Or you can, select that, okay, whatever long-term, see, there are two views to it. One view is you can say that whatever long-term capital gain is, we will charge under 112 because 112A is not applicable. Or you can take an alternative view that even 112A, if it is not applicable, we'll charge at maximum marginal rate. So the view which ICAI has taken is that whatever long-term capital gain are will be taxable under 112 for a REIT and 112A will not be applicable. Are we clear?
Then if the shares getting sold, then maximum marginal rate would be applied.
No, 112 will be applicable. No, that's what I'm saying. The ICAI's view is that if there is any long-term capital gain, then we will just apply 112 and we will not apply the maximum marginal rate. If it is only for short-term, other than 111A, short-term is there, then only maximum marginal rate will be applicable.
Yes, ma'am.
For
Clear.
long-term, it's only 112. Okay?
Yes, ma'am. Thank you, ma'am.
So now what we are left with is only the repayment of debt, which we will do it in the next class, and then we will also solve a question. So I will request you to please revise this REIT concept and come for the next class. We will solve one question from module after finishing the repayment of debt by the REIT to the unit holders, and then we'll solve a question and then we will move to the charitable trust. Are we clear? Any questions, any doubt before we close the session? Yes,
Clear, ma'am.
clear? Okay, so all of you just please revise the lecture and then come for the next class. Thank you so much. See you in the next class.
Thank you, ma'am.
Thank you, ma'am. Good night.
Good night. Yes. Thank you.